So let's take a critical view of Palantir Technologies. This stock recently posted earnings, and everybody that is in love with AI has been really kind of putting this at the forefront of that movement. And the stock is trading down 5% after earnings. It hit a 52-week high of just around $20 a share, and year to date is still holding up a whopping 166%. Let's take a look at some of the headlines that are driving the current volatility in the stock, and then we'll take a look at the actual earnings to show you some stuff that you may have missed. Now, Palantir reported 13% revenue growth and issued guidance that actually topped estimates. And this looks pretty good all in all, but I think investors are a little disappointed in the fact that revenue has actually been declining pretty much every single quarter, pretty much since its peak of 2021-ish time period, 2022. Currently, the last biggest growth cycle they had was around 17% for the first quarter of 2023, and now we're down to 13% revenue growth. So I think that is hindering a little bit of the growth in the stock value, but we're going to read into just a few of the highlights of this article. First and foremost, EPS was 5 cents adjusted versus 5 cents as expected by analysts, according to RINFIV. Revenue of $533 million versus $533 million expected by analysts. But more importantly here, again, I think the guidance doesn't make a huge difference because basically the full year revenue was estimated to come in at about $212 billion, above the midpoint of the forecast from May. Analysts polled by RINFIV had expected about $2.209 billion. But Karp did say the CEO said, we anticipate that we will become eligible for the inclusion in the S&P 500 after we report our financial results for Q3 2023 in early November. CEO Alex Karp wrote this to a letter of the shareholders. At this point, we will have been profitable on an accumulative basis for over the preceding 4 quarters. Now, taking a look at the actual earnings themselves here, I think there's a few things to highlight that are, all in all, I would say a little lackluster from the performance aspect. Outside of growth slowing down, they did announce $1 billion in share buybacks. But if we actually scroll down and take a look at a few metrics here, the share buybacks, I think, are just to help cushion the blow, probably between some stock-based compensation of some insiders, perhaps, because we can see on the diluted basis, if we just take a look here for the 3-month end 2023 and on the weighted average shares of outstanding used in computing net earnings, we can see they had about, 2.27 billion. So they're going to be buying back about $1 billion. I think that comes to a rough cost of just over 50 million shares. I think if I ran the math on that correctly, don't quote me on that, but you're talking about pulling back not even enough shares to nullify them to where they were this time last year. So the share buybacks aren't going to make up an accumulative difference. It's also very important to point out here that they are spending an increased amount on sales and marketing, research and development. Those costs continue to go up, whereas most of their income right now is coming from interest income alone. So this company is primarily just taking leveraged capital that they probably raised in the past. We're probably talking about some billions of dollars. They have it sitting in a high interest account, and it made them $30 million, which is where most of their GAAP profitability has come from, whereas their basic operations are only generating about 10 million. So these are things just to be aware of when it comes to Palantir. There is some mild manipulation going on to make it seem a little bit better than it probably is. But honestly, I'd love to know the marketing campaign behind the company to see if it's relevant. As Alex Karp has mentioned in the past, they have had a huge amount of demand and people taking interest in their products and services. So if they could even cut marketing and some research and development costs ever so slightly, they could really bump GAAP profitability, because there's an inevitable future ahead of them where they won't be able to make as high of interest income, because there's a presumption that interest rates won't stay as high as they are now. But the company does have some runway here, and it'll be neat to see if they can get to the point of being listed on the S&P 500. But I'll pass the question off to you. As always, we'd love to know what you think in that comment section below.